Generally, finance is the study of banking, leverage, credit, capital markets, money, and investments, along with how they are used by individuals and companies. Many of the basic concepts in finance come from micro and macroeconomic theories. One of the most fundamental theories is the time value of money, which essentially states that a dollar today is worth more than a dollar in the future. Finance is often segmented into public, private, and corporate finance. The public finance sector includes government tax, spending, budgeting, and debt issuance policies that all affect how a government pays for the services it provides to the public. Corporate finance refers to the financial activities related to running a corporation. Personal finance applies to individual consumers and the ways they manage their spending, save for the future, and pay for basic needs. These three categories contain many subcategories, including behavioral finance, intangible finance, experimental finance, and financial mathematics. In addition, finance is often used as a general term to refer to borrowing money on credit to pay for something. For instance, if Dane needs to buy a new bathroom sink for his home remodel but does not have enough money to pay for it, he may use the buy now, pay later credit offer from a large retailer to finance his purchase.
It's the role of the Chief Financial Officer to monitor and interpret the business's financial information. Finance, in its broadest sense, has become the driving force in U.S. corporations. Gary Coughlin is the Senior Vice President of Finance and Chief Financial Officer for Abbott Laboratories. Abbott is among the world's largest and most successful corporations, with more than 56,000 employees, a presence in approximately 130 countries, and worldwide sales of around $12.5 billion. Although no single person is responsible for all the financial decisions, the CFO is charged with the majority of these responsibilities. Top management is continuously involved in financial decisions, as are people in every department of the company. The Chief Financial Officer, or CFO, leads the finance department, and the key financial officers report to the CFO. The treasurer and the controller are next in the chain of command. The treasurer raises funds and manages the company's capital structure, and the controller manages budgeting and accounting. While auditing is often part of the controller's responsibilities, at Abbott, audit is a separate function with an audit vice president reporting to the CFO. The CFO is deeply involved in financial policy making and corporate planning. Often the CFO will have general managerial responsibilities beyond strictly financial issues, and may also be a member of the board of directors, although Mr. Coughlin is not on the Abbott board. The CFO may take on operating and strategic responsibilities, but those duties grow out of what remains the core of the job, maintaining the corporation's financial strength and maximizing shareholder value.
Well, the basic role of CFO is changed over time, but essentially have the key issues in maintaining the financial value of the firm and maximizing shareholder value. Those have always kind of been the preeminent activities that the CFO gets involved in. But as time has changed, you become more of a partner with the operating management, whether it be the CEO or the division management. So the CFO's responsibilities are broadened into the areas like strategy and change initiatives. Okay. And examples would be you might be called upon to champion a growth initiative or some other new thing or cultural change, such as how would you do total quality management in the organization, or other such strategies as, how is e-commerce going to affect the business? So, you get into those kind of activities, which in years past you wouldn't have. You'd have been mostly into the financial, just kind of maintain a balance sheet, an income statement, and so on. So even though that becomes the financial stewardship becomes, it's still the foundation of the job. It's just become much broader.
One of Mr. Coughlin's most important responsibilities is communicating financial information. He is accountable to the board of directors to be an independent advisor and to provide correct, detailed financial information. Investment analysts and shareholders also rely on the CFO to provide accurate financial data.
Generally, in most major corporations, the CFO is one of the primary interfaces along with the investor relations department with the investment community. And the investment community means in most cases, both the sell-side analysts, those people who write research on your corporation, as well as buy-side analysts, who represent the major institutions who invest in your stock. And then also you have conferences for individual investors. So essentially, the CFO is kind of the one who oversees that function. And what the key job is you have to make sure that you have the right information out there. Today's markets are very volatile, and you can see if you miss your estimate by a penny, stocks can go down 5 to 10%. And so there's great scrutiny on quarterly earnings in the United States and how that impacts your stock price. So the CFO has to make sure that you get the right expectations out there, and then they have the most valid or available information that is not proprietary and can be disclosed, so that the investors can make the appropriate decision.
Hello, Business Finance 330. This is Professor Hasse, and this is our Week 1 online lecture for our Business 330 class this session. The name of the class is Corporate Finance, and you've seen a couple of videos prior to this PowerPoint presentation that define finance and define the role of finance in corporations. The bottom line, maximize shareholder value. Bring in the most return to satisfy the demands of your investors. Who's an investor in a company or a corporation? Banks, bond holders, institutions that lend you money, stockholders, investors who give you their money, and in return they own stock in your business and are considered equity holders. Private equity investors. If you ever watched the show Shark Tank, that's what private equity investment is. Venture capitalists. Hedge funds invest private equity. And also, other investors of a company are naturally the employees of the company. They have a pretty good stake in the business. Vendors, people who sell you products that you use in your business. So these are all investors that you need to maximize and make sure the return for the company is adequate. That's the role of finance in corporations. Corporate finance is important to management because the knowledge of capital budgeting is the analysis of investing in an asset and whether that asset will return enough cash flow to warrant the investment. Capital structure. Capital structure is how you finance the purchase of an asset. Remember, there are 3 ways you can obtain capital in a corporation or any business. You can borrow it, you can issue equity, stock, and you can make a profit. Those are the 3 ways of obtaining and financing the capital structure of your company. And working capital, that's the day-to-day cash flow of a company. Are you having enough money to pay your payroll, your accounts payable, your weekly taxes? That's working capital. So corporate finance is important to management because the knowledge of capital budgeting, capital structure, and working capital provides for effective decision-making if the corporation is to maximize profits and stay competitive for future success. And that's the topic of our first week of this finance class. Chapters 1 and 2. What is finance? What are the financial markets that you go out and obtain this capital? There are 3 main principles of finance. 1, the investment principle. Are you returning enough cash flow and profit off an investment to cover the cost of that investment? And that another definition of the cost of an investment is the hurdle rate. What's the cost of investment? Well, if you're borrowing money to purchase an asset, the cost is what? Interest. If you're issuing stock to fund the purchase of an asset, the cost is the expected return of the investors on that stock. If you're using profits from prior years to fund an investment or a purchase of an asset, The cost is what you're giving up by investing those dollars in this new project versus where those dollars were invested before. That's the cost of using profits. In this class, we'll find out how to calculate those three costs. Very important to finance. The second principle is the financing decision or financing principle. How are you going, where are you going to get the money? What is the optimal mix of debt and equity? We're going to look at an expression and a calculation in our class called weighted average cost of capital. What is the average cost of obtaining capital by either debt, equity, or using profits? And then finally, the dividend decision. How you fund and how you would distribute the return you get off an investment in assets. Will you pay back dividends? If it's a loan, will you pay back the loan naturally and with interest? How you will return the cash flow off an investment to the investors. That's a big one because many times companies do not pay dividends to hang on to that cash for reinvestment in the business. But other companies, investors demand dividends or they'll sell the stock. And that's a key decision for many companies. There are three types of business organizations in capital. The most important one, or the largest one, which we'll center on in this class, is the corporation. But there's two others. Sole proprietor, which is a one-owner business, usually a lot smaller. Sometimes they're called mom and pop shops. And then a partnership, a group of individuals get together and start a CPA firm, maybe a law office or a medical practice, partnerships. But in recent years, maybe 20, 25 years, that has all changed to incorporation. Now, most public accounting firms, law offices, and medical practices are incorporated. It's called LLC, Limited Liability Corporation, Limited Liability Partnership. What does that mean? Well, prior to the tax law changes, if you own your own business or were in partnership in a business, if you did something wrong and a customer or an employee or whatever sues you in that lawsuit, because you're a sole proprietor and partner, they can not only sue the assets of the company, but they can sue you, the individual owner of that business. They can go after your money. They can go after your assets. But when the tax law changed in about 25 years ago, around 1998, the tax law now allowed small businesses and partnerships to become incorporated. It's called limited liability. So you can form an LLC or what is also called a subchapter S corporation. By doing that, you can still run the business, but be tax-wise and liability-wise, be treated as a corporation. Meaning, if somebody sues you for malpractice or whatever, they can only sue the assets of the company. They cannot sell or sue the individual ownership of the business. That is a huge advantage to the risk of investing in corporations when you know you will not have any liability if the company screws up. Yes, the stock of the company will go down probably. And if you're a stockholder, that's not very good. But individual lawsuits or liabilities do not affect ownership. Another interesting characteristic of a corporation is that they're double taxed. The sales and the revenue and the expenses produce a net income of a company. And that net income is taxed at the corporate tax rate. The current corporate tax rate is about 18%, including state and federal taxes. At the same time, once you distribute and pay those taxes, the remaining profits that are left over for many companies are now distributed as dividends to the ownership of the company. Once those shareholders receive those dividend checks, that is taxed on the shareholders' return as ordinary income. So the government, the federal government and the state governments where you do business in, you have to pay a tax on your own personal or your own corporate return. And then when you distribute those dividends to shareholders, the government gets additional tax revenue on those dividends. But the reward for corporations is easier access to huge amounts of capital because of the limited liability risk. They have much more options to obtain capital. That's important. And why do we need to obtain capital? You have to stay competitive. You have to grow your business. You have to grow your market. Thus, you need capital to fund that growth. Show me a company that does not grow and stays the same. Eventually, they're going to lose their market. They're going to lose their customers because their competitors are putting out better products and better services. You have to grow to compete. Thus, the need for financing and capital. This is my high-tech slide. As we've said numerous times already in this video, management's responsibility is to maximize shareholder profits. And here's a manager of a company jumping up and down to see what is those maximized profits look like. How much money do we have to make to satisfy our investors? But one of the changing things in corporate finance and corporate management is there's other objectives involved. What is the manager's responsibility to achieve these maximization of profits? There's ethical decisions, responsibility to society. Are you treating your employees ethically? Do you pay your women workers who work the same jobs as the male workers the same amount as the male workers? Do you pollute the environment around your businesses? Do you treat and pay your people fairly? That's a key objective also for corporations and has to apply to the financial strategy of any business. I mentioned earlier, one of the key ways of determining the cost of investing or investing in assets is the weighted average cost of capital. We'll spend much time on this in about week 5 and 6. The cost of borrowing money, the cost of issuing stock. You're going to have to make a higher return off that asset higher than your cost of capital. If you don't, you're wasting your time. There's other conditions that affect maximization of profits. What's the current government policies where you do business? What's the political and social environment that you're doing business in? You see this every day in the news. Companies do business with China, in Mexico, in many countries. And they're subjective to the government policy and the social environment of those countries. Many of you are familiar with the exchange rate or the cost of currency, the United States dollar versus the Mexican peso, the United States dollar versus the euro, and so on. That makes a big determination of factors that you can make a profit. Very important in the study of finance. And you get this capital, you obtain money and management sources in the financial markets. If you're issuing stock in an IPO the very first time, it's called the primary markets. This week in our class, you're doing an exercise of putting together a portfolio of stocks. Talk more about that later. That's called the secondary market. You're purchasing and buying and selling stock that's already been initially issued by the company. The company's made their money. Now they're out of it. And now the people who bought that stock originally are now selling it to the other markets like you. And we mentioned this earlier. There are private markets, venture capital, hedge funds, private equity sources. And then there's the public markets, the New York Stock Exchange, the NASDAQ exchange, public places where you trade and trade equity. We're going to learn about those markets in our finance facts in each week of weeks 1, 2, and 3 in your Blackboard. What's the definition of a market? The S&P 500, the Dow, the NASDAQ. Key areas of the marketplace that you need to be aware of. The New York Stock Exchange is where most of this trading is done through digital networks. Many of you might even have a Robinhood account, a Charles Schwab online trading account. Everything flows through that New York Stock Exchange. Then there's the NASDAQ exchange, which is over the counter, which is done by computer. Chapter 2 is talking about these financial markets and understanding them. The United States $100 bill. The United States dollar is the strongest currency in the world. Why? It has the largest economy behind it. It has, and this is debatable in some circles, it has the strongest, most reliable democracy in government. It has the largest and strongest military to protect this economy and government. Socially, culturally, it drives the world in the markets. Entertainment, movies, video. The United States dollar is strong because we create a lot of the entertainment of the world. Every day, many people like me get up and track leading indicators of the markets. There's a couple of slides of these key indicators. Now, I'm not going to ask you to go out and memorize these and follow them during the course of our class, but if you want to be a financial manager with a company, if you want to be a manager of your investments or have an idea what your investments are doing, be it 401k, pension funds, or whatever, you need to know what's going on in the world around you. As of last Friday, August 18th, 2023, the equity markets in America, represented by these indexes, the Dow Jones Industrial, the Standard & Poor's 500, and the NASDAQ index, these are all defined in the first 3 weeks of our class in our Blackboard. They're all up. The Dow is up 4% from December. S&P 500 is up almost 14%. And the NASDAQ exchange is up 27% so far this year. That's a lot. People are investing in the equity markets, and they're doing very well. The next indicator is called the 10-year United States Treasury yield. That is called in many circles the benchmark interest rate for investors and for people borrowing money. It's also called the risk-free interest rate, which we'll get into when we talk about weighted average cost of capital. The risk-free interest rate means that if you lend the United States government $1,000, that's the denominations of bonds in the United States Treasury, you give them $1,000 of your money, they have to pay you back in 10 years that $1,000. In between those 10 years, every year they will give you a check of 4.251% of that $1,000, or $42.51. That's guaranteed. You're going to get that money no matter what. Now, that doesn't look too exciting, but to many investors, that's risk-free. You know you're going to get paid. You know you're going to get your money back. You can't say that about investing in Tesla or even Apple Computer. It's not guaranteed. This is guaranteed. But notice what has happened to the interest rate in the 8 months so far this year. It's gone up 3.8 to 4.2. That's called inflation. All mortgage rates, credit card rates, auto loan rates are driven by this 10-year United States Treasury yield. Then you have your commodity indicators. The two most popular commodities, naturally, are crude oil, which still to this day, even though the use of crude oil is diminishing, it's still the most important commodity in the market, and gold. Gold is a hedge fund. Gold is someplace to put your money when you think all else is not doing very well. Naturally, with the stock markets doing so well and inflation rate high, gold is not doing that great. It's up, but not like the markets. And then you have the three main currencies in relationship to the United States dollar: the euro, the Chinese yuan, and the yen. Even though Japan has an economy that is not as big as the United States and China, Japan is our largest lender. We borrow most of our capital in government from the Japanese. They like lending us money. So notice, as you can see, except for the euro, the United States dollar is stronger to those currencies so far this year. And what does that mean? It means that if I wanted to take an American automobile and sell it in Tokyo, it's going to cost the Japanese people buying that product in Tokyo a lot of money, because the United States dollar is so strong. That means the value of that car is going to be higher. It also means that Japanese products sold in this country are going to be cheaper. We will take a look at that. It's a key relationship, a key strategic relationship in the study of finance. And there's our main competitor, the Chinese yuan. China is the second largest economy in the world. How we gauge our performance is how they grow, how their economy shrinks, whatever. They're our main competitor. Also, they're our main partner. Anybody been to Costco lately? How many of those products in Costco are made in China? Boggles the mind. So this is one of the interesting things about studying finance. China is our biggest competitor, but also they're our biggest partner as well. Japan is our biggest lender. They lend us their money. China provides us with products and goods and services that we purchase. This means a lot to how the world economies work today and going forward. So one of the exercises you're doing this week is to begin to understand the markets. Many of you probably already do. But part of the key disciplines and the key study of the early weeks of this class is to understand the environment companies go out and raise capital. So as you can see in the discussion forum in our Blackboard for week 1, I'm asking you to do two things. I'm asking you to write a bio about yourself. Tell us a little bit about yourself. And I'm asking you also to create a spreadsheet of up to 5 stocks that you would like to invest and track this coming 8 weeks of our class, and invest up to $100,000 in those stocks. It has to be $100,000. You can pick one stock or one company and put all $100,000 in it. Or as you can see, this is my portfolio for this class. I'm selected Apple, Exxon, Navda, and Disney. This is the stock I'm going to purchase this Friday at the close of the markets, August 25th. And you're going to be picking your companies and tracking this throughout our class. So what you're going to do on Friday when the markets close, they close at 1 o'clock Pacific time. After the markets close and everything's settled, you're going to pick 1, 2 through 5 companies. You're going to allocate an investment to those companies, and you're going to find the closing price on Friday, and that's starting up your portfolio. Now, I'm giving you a PDF file here as an example, but I want you to submit this work in an Excel file so I can see your calculations in the cells and see how you set this up with this format in either Excel, Apple Numbers, or Google Spreadsheet. If you decide to use Apple Numbers, before you post your file to Blackboard, you need to export that file to an Excel format, please. So here's what you're going to do, and let me explain to you what I did. Now, naturally, this is not Friday, August 25th, so we haven't bought the stock yet, but I picked 4 companies, and I'm allocating $25,000 to each company. So on Friday, when I get the stock price of Apple Computer, and let's say it's $154.50, which is a little bit off to the current market conditions of Apple, I will take in this cell here where it says shares, I will divide $154.50 into my allocated investment of $25,000 to get the number of shares I'm purchasing on Friday. I should see a formula in this cell taking this number and dividing it into this number. And then your number here will be rounded to the nearest whole number. So you're going to do that for 1 company or 5, or in my case, 4. Of allocating and selecting portfolios. Then throughout our course at different stages, once during one assignment and another in our final examination, you're going to be doing a valuation of your portfolio to see how these prices have changed and how your holdings have gone up and down over the course of our 8-week class. At the same time, you'll be tracking the 3 leading market indicators that are discussed in our weeks 1, 2, and 3 in Blackboard, and getting their index values at these points of time and seeing how they change over the course of 8 weeks compared to how your portfolio changes over the 8 weeks. Remember, once you select the stocks on August 25th, that's it. You can't change that after your initial buy. You can't change that if something's gone wrong with your company. You're stuck with it for the 8 weeks of our class. So this is the assessment work of our online class this week, due on Sunday, August 27th. You are to, and I'll show you that in just a minute. Let me get that up here. Here's the Blackboard for our course. And based on my introduction video and some beginning preliminaries, you should be familiar with this right now. You go to the student discussion forum, and there's your work assignment for this week. A 2-part posting by the student. Part 1, a biography about yourself, and Part 2, the spreadsheet selection file of your planned portfolio with $100,000 investing. Remember, your investment dollars will total $100,000. That will drive how many shares you purchase at the stock price at the close of the market on Friday, August 25th. And I've shown you that sample, and also in the discussion forum, there's that file that I just showed you as a sample, but you need to put this in to a spreadsheet file with that format. Once you have that file posted to Blackboard, I also would like you to give me some 1 or 2 sentence explanations of why you picked the companies that you did pick for your portfolio. So you go to the Blackboard discussion forum and click it on, and you will create a thread. The subject will be your name, HASI, bio, and portfolio with the correct spelling. And then down here, you will type in your bio. You explain why you picked your portfolio companies. And then you would attach, by hitting this sign here, you will add your file, spreadsheet file, to the thread, and I can see it and download it. That's our assignment this week for 10% of your course grade. That's our assignment this week. Need to put that together and post it by Sunday, August 20th, 2027. Remember, the price has to be as of the close of the market on Friday. You can't do this on Wednesday or Thursday because that's not the price of the market. You need to go to Friday's close. Now, let me show you how you would do that, especially if you don't have much experience in this. Here I am with my browser, and I go to Yahoo Finance, finance.yahoo.com. And up comes a very user-friendly website to look up stock prices. So let's say it's a Friday evening or Saturday morning or whatever, and you picked Apple Computer. You type in the search box, Apple. There's Apple Incorporated with the symbol, the exchange it's traded on, and you hit that, and up will come everything you wanted to know about Apple Computer but were afraid to ask. Today, Apple closed at 1 p.m. Pacific time at $177.23. That's the number you want to look at the close of the market on Friday, August 25th. Now, if you do this on Saturday or Sunday and you miss all this deadline, you can just go into historical data and it'll list the date of the closing on Friday right here. Now it's up to August 22nd here, but you would list that and get the closing price. Yahoo Finance is easy. It's easy to get around with. It's easy to get information. Also, in Yahoo Finance, you can click on and get the current prices of the S&P, the Dow, and the NASDAQ. So this can be an easy source. Now, you can use whatever source you want, but for first-time users of doing something like this, first of all, you're going to be stressed out about using the spreadsheet and creating that. But secondly, I got to feel comfortable where I get the data, and this is pretty easy. Yahoo finance.yahoo.com. Okay, so that's our assessed work for this week. If you go to week 1 in our Blackboard, there's our learning assignments for this week. There's the introduction video I posted the other day. And under week 1, under class notes and review, here's another sample PDF file of that portfolio we just looked at. And here's the PowerPoint presentation that I just went through my lecture, defining what is finance, what are the goals of finance, and what are the capital markets, the subjects for week 1, chapters 1 and 2. Now, as I indicated in my introduction, we will have 2 videos every week. This isn't the startup week, so my video is on Tuesday for our lecture, but always our lecture after this week will be on Monday. And the second video for you to review will be posted Saturday morning of every week, which will be a review of the material, maybe some selected problems that I will look at from our reading chapters that will give you some better idea about the importance of certain topics in those chapters, and also to give you background for the assignments that are coming down the road. And speaking of our assignments, if you just go to our course syllabus and schedule, you can see the schedule of our assignments coming up. This week, you have the student bio and portfolio. Next week, September 3rd, and sorry, it's Labor Day weekend, you're going to be meeting with your professor, me, Rick Hassey, I'm going to post a schedule this weekend, and you're going to pick a day and a time where each of you individually will be coming on Zoom and talking to me, and me getting to know you and answering any questions or concerns you have about the course. It'll take about 5 to 10 minutes with every student. And that's, if you complete that and meet with me, that's 5% of your course grade. And then also next week, you will be given an assignment to do about this first week of study, due on that September 3rd, and I'm sorry, Labor Day weekend. Now, when we're on the subject of assignments, let me make things clear. We're going to be doing a lot of material over 8 weeks. So if you need extra time beyond the Sunday due date of anything, all you need to do is send me an email and say, Mr. Hasse, can I have a couple extra days to post this week's work? Can I post it on Monday? Can I post it on Tuesday? I do not have a problem with that, and it will not affect your grade whatsoever. Because as you can see, we're almost doing some work or graded work every week throughout the 8 weeks of this class. So if you need extra time, no problem. Just let me know. If you don't let me know, I won't be able to turn off the block on our Blackboard Grade Center, which is set for midnight every Sunday. So if you don't post by midnight Sunday, that is going to block you out, and you won't be able to post anything after midnight. But if you let me know you need an extension, I will undo that block so you can post on Monday or Tuesday. Usually my cutoff date for any work week of the prior week is usually Wednesday. Get your work done by Wednesday. The reason for that is I want to get the grades for that week posted on Thursday or Friday, so you see immediately how you're doing and what's your course average. And remember, we've talked about this in our introduction video. This is our assignments and discussion points of our class this fall. So that concludes this week's work, week 1. I'll have a follow-up video with some more information on Saturday morning. You have a discussion forum to post. You could do your bio right now, and then you can create another thread with your portfolio information this weekend. Remember, we have student hours every Thursday evening from 6 to 8. The link is in your syllabus, and the link also is in your Zoom and YouTube links site right here if you want to log in on Thursday and ask me any questions or get any help. Look forward to working with you all. Our next video will be Saturday morning as we conclude this first week of our study. Stay on top of this stuff. Don't let it backlog, or don't wait to the weekend to do it all. This week you can get away with that. But as we pick up the pace in this class, that's going to be a very difficult schedule to maintain. Try to do a little work during the week if you can. All right, everybody. Have a great week. Until next time, adios.